you're disrupting about 20% of global oil supply and global LNG supply. So, to be very clear, we cannot balance as a global economy without these flows for very long. If it's a short-lived disruption, sure, we'll make up for it over time. And in the case of natural gas, because we have that really strong seasonality of demand where you come to winter, that's when you really use it. That's when heating demand is the highest. It's almost like you have a deadline ahead of you. You better offset all these losses by end of October because you're going to need that gas from November.
Welcome to Smarter Markets, a weekly podcast featuring the icons and entrepreneurs of technology, commodities, and finance, ranting on the inadequacies of our systems and riffing on ideas for how to solve them. Together, we examine the questions: are we facing a crisis of information or a crisis of trust? And will building smarter markets be the antidote? This episode is brought to you in part by Abax Exchange, bringing better price discovery and risk management tools to navigate today's commodities markets through centrally cleared, physically deliverable futures contracts in energy, environmental, battery materials, and precious metals markets. Smarter markets are here.
Welcome back to Weathering Decarbonization on Smarter Markets. I'm Dave Greely, Chief Economist at Abax Technologies. Our guest today is Samantha Dart, co-head of Global Commodities Research at Goldman Sachs. We'll be discussing how our changing energy system is weathering the conflict in Iran at the same time as it's weathering decarbonization. Hello, Sam. Welcome back to Smarter Markets.
Good to see you again, Dave.
It's great to see you. Thanks for making time to join us. I know this is an incredibly busy time for you, and I've been wanting to talk with you about how our energy system is changing and how it is weathering decarbonization. But of course, we need to talk about how it's weathering the conflict in Iran. Our energy system has been changing, becoming more electrified, more dependent on a natural gas market that's also globalizing through LNG. In some places, that's being driven by the desire to reduce carbon emissions, in other places, by the desire for a more secure energy supply. How are you seeing these motivations playing out in different regions of the world? And how big of a motivation is the desire to be more energy self-sufficient, given the supply chain concentrations and disruptions that we're seeing around the world?
Yeah, I think the push for self-sufficiency has really picked up over the past few years. And it's not just about energy. If you go back to the pandemic, we saw how vulnerable our supply chains are. And right after that, you go to 2021, China faced an electricity crisis. They didn't have enough coal. So from that point on, it was interesting to see China decided to go full on coal and renewables, even more than what they were before. They were investing in coal production significantly. They were stockpiling and breaking records in inventory levels year after year after year. Those are the two things that they can do to generate power. They can produce coal, stockpile it. They can build renewables. So they've done both at an incredible pace. So it's been a real push for security of energy supply. And it's really hard to make the argument, oh, they've gone for decarbonization because they're doing a lot of renewables. They are, but they're also doing a lot of coal. So you can see that the priority so far is really security of energy supply over decarbonization. And not long ago, they published their 15th five-year plan, where they reiterated their intentions to indeed start decarbonizing more forcefully from 2031. So it is still in their horizon, but it's not priority number one right now. And it makes sense. If you look, for example, at how commodity supply is concentrated, we're so used to thinking of commodities as these amazing global markets, very fungible. Yeah, right. But supply is concentrated. China dominates over 90% of refining of rare earth metals. It dominates on refining of aluminum, of copper, of other metals, whereas the US dominates on the energy front. So you end up seeing these initiatives where China is pushing towards EVs to be less dependent on oil. China is relying, as we just discussed, on coal and renewables for power generation and is keeping the natural gas share in the single digits. And on the US side, we have now tariffs on steel, tariffs on aluminum, trying to incentivize maybe some sort of revival of investment in production in metals here in the US. And we have Project Vault. So you're seeing more and more initiatives looking for more independence. I think in that respect, Europe has sort of lagged behind because Europe still imports almost 50% of its energy consumption.
And now we're seeing, of course, a real test of those preparations or lack of preparations because we have the disruptions caused by the conflict in Iran, which is affecting both oil and, importantly, LNG. How are you thinking about the size and impact of this disruption?
Yeah, you're disrupting about 20% of global oil supply and global LNG supply. So, to be very clear, we cannot balance as a global economy without these flows for very long. If it's a short lived disruption, sure, we'll make up for it over time. And in the case of natural gas, because we have that really strong seasonality of demand where you come to winter, that's when you really use it. That's when heating demand is the highest. It's almost like you have a deadline ahead of you. You better offset all these losses by end of October because you're going to need that gas from November. So you have the market positioning itself to look to offset these losses in gas and potentially even in oil. Oil has less of a sense of urgency because it doesn't have such a strong seasonality of demand. So if we start next year at lower levels of inventories, as long as they are not critically low, that's all right. We can rebuild over time. But even in oil, every time you see Brent crossing over $100 a barrel, to me, the signal that sends is exactly that the market is becoming a little bit more concerned that we might need to destroy some demand in addition to incentivizing maybe a little bit more supply from the US over time.
I guess I should have also brought up one of the outsized impacts of this disruption has been on the refined product side, in particular with jet fuel. Can you talk a little bit about what's happening there? And is that going to mean that the impact we experience as consumers could be much bigger than what the price of the movements of crude oil, as large as they've been, would make you think?
It could. I think it's already starting to be passed through to ticket prices, airline ticket prices. I think that the whole refined product complex has already been under a lot of pressure because the utilization rate at refineries had been running very high. In addition to that, if you remember, the several drone attacks from Ukraine on Russian refineries made that worse. And you have a significant share of global supply of jet fuel that would normally cross the Strait of Hormuz as well, that is not crossing at the moment. So, jet fuel in particular is very tight right now. China just restricted exports as well. So, it's almost like the reaction we've seen on crude a little bit exacerbated because the balance was much tighter to begin with. If we focus on just where crude inventories were, and okay, to be fair, SPR reserves were relatively low, but OECD commercial stocks of crude going into the year were pretty average. If you look at China's strategic reserves, were above average. So crude had not been particularly tight. In fact, we were coming from a very big surplus from last year. Products are different, tight inventories, export restrictions, and again, this big supply disruption that would have crossed the Strait of Hormuz under normal circumstances, and now it isn't. So you're absolutely right. The percentage rally we've seen in jet fuel is far larger than what we've seen in crude. And again, this is already being passed through to airline tickets in the same way that gasoline prices have already rallied significantly as well in the US. We're above $350 a gallon. And it matters because if you look historically, when gasoline prices cross that 350 threshold, usually that's when you see more and more of this topic popping up in the news. So it becomes a little bit of a point of political pressure as well.
Yeah, and we are very accustomed in the US at least to thinking of the impact of an energy shock in terms of the price at the pump. But with natural gas driving so much of the price of power more and more, do we also need to be thinking of the price at the plug? What's been the impact on power prices so far?
Yeah, I would start by saying this is an issue more for Europe and Asia than it is for the US. The US is actually pretty insulated from all this on the natural gas side because, number one, the US is a net exporter of LNG. But importantly, and that's the second point, it doesn't have spare capacity at its LNG export terminals. So you can have international prices, European and Asian prices at $20, $25 an MMBTU. And I'm sure the exporters in the US would love to sell a little bit more into those types of prices, but they can't. You have only so much capacity that you can export from. And as a result, your balance of natural gas in the US is still pretty much what it was, and it has been very comfortable this year. So I don't expect higher US natural gas prices. And as a result, you don't end up seeing this pass through electricity very much. To be fair, you do have a little bit of a pull higher on Appalachia coal prices because that is a kind of coal that is exported. And you already see European coal a little bit higher, Asia coal a little bit higher. So you have some correlation there to the extent Appalachia coal sets the marginal electricity price in the Northeast. Sure, you see a little bit of that, but it's not as significant as the potential impact on electricity prices in Europe and in Asia. The other thing I would point out that is interesting for Europe in particular, the share of renewables has grown so significantly that you now have a few hours during the day when gas is not at the margin. So, yes, you have had a bit of a pass through from the rally in gas to the rally in electricity, but not one to one. Because if you're not at the margin all the time, you're not setting your electricity price all the time. And then the way that forwards price that in, say for next year or even for next month, it's not one to one because you have that little bit of offset as well. But in general terms, yes, this is a higher cost of the fuel and at the margin, a higher cost of electricity as well. As a result, we are already seeing headlines of users of gas and electricity having to cut back a little bit, and both in Europe and in Asia.
And it's fascinating, right? Like when I listen to you talk about the different regions of the world, you can see how the energy systems are so different in each, with China stockpiling coal, having a lot of installed renewables, the US, plentiful energy, more natural gas than it's able to export. So it's a bit of an insulated island in that sense to this disruption. And Europe kind of having more installed renewable capacity, and that's helping it so far. And I was wondering, like 10, 20 years ago, people talked about the closure of the Straits of Hormuz. That was kind of the worst thing that could potentially happen. But now, is the way our energy system evolving? Is that changing the nature of how you think about the effects of an energy shock?
It depends on the scale. I still think that a disruption like the one happening right now has too large a scale to be allowed to last very long. I still think that despite all these caveats that we're here discussing, we cannot balance. We need that energy to produce petchems that turn into plastics, to produce pretty much anything in manufacturing that they need that furnace burning, whether it is with gas or with coal or with oil. You need that to burn, generate steam, get your manufacturing processes going. And if you all of a sudden take out 20% of it, somebody's going to lose out. In 22, what we observed is that even though there was a concern that Europe was going to face rationing of gas during the winter, so there were a lot of concerns that heating related demand was not necessarily going to be met. In the end, Europe was fine, but we did see blackouts, we did see outages in India, Pakistan, Bangladesh. So you end up in the system where, okay, we don't have enough of these fuels, prices rally. And at the end of the day, those more sensitive to the price spikes are the ones without the fuel.
And how do you think this shock so far is comparing to the loss of Russian gas into Europe at the start of the invasion of Ukraine? Was it just that Europe was so dependent on gas this time, and this is more of a global shock? How are you thinking about the two differently?
Yeah, there are a few differences. In terms of volumes, it is similar. At the end of the day, Russia curtailed about 12 BCF a day of gas to Europe over time. Like the cuts were growing over time. So this was sort of the ultimate loss. And the loss of Qatari gas is about 11 BCF a day. So it's similar in that respect. But I think the biggest difference is with Russia, this was a structural change. It wasn't 1, 2, maybe 3 weeks. No, this is okay. From now on, we cannot count on that natural gas. So we have to find a way to balance not just this year, not just next winter, but going forward. So it's a dramatic change that is structural in nature. But what we see right now, at least the expectation is this is not going to be a structural change. This is not going to be long lasting. Also, because we can't really stomach that on the oil side either for much longer. Prices will react to try to offset this. So you have this volumetric similarity, but duration difference. I think another interesting difference is at the time of the curtailments of the Russian gas, European gas demand was higher. Their power demand was higher. Their industrial demand for gas was higher. Their heating demand for gas was higher. We went through a lot of demand destruction during that first winter that became structural as well. The curtailments on the industrial side, if you look at industrial demand for natural gas in Europe, it's still at the lows from post 22. It has not recovered. Power demand, now because you have a little bit more of data center push, you have power demand starting to recover, but power demand for gas, not so much, because at the same time that power demand is growing, you continue to add renewables. So your overall demand for gas is not what it was. And this can help Europe a little bit because that means to rebuild storage levels over the course of the summer, it's not as hard as it used to be because your demand is not there to the extent that it was. Even heating demand. We had so many installations of heat pumps across Europe that you saw a step down in residential and commercial demand for natural gas. To be fair, it didn't keep falling. It was a one-off. But still, today we have less demand in Europe than we used to. So this helps a little bit.
And as you've said, it's all about how long this goes on for. And I'm wondering the initial hit, like, because we do see the Qatari LNG offline, where is that coming out of the system? Is it coming out of inventories and storage in Europe at this point? Or like, who's feeling the shortfall thus far?
So Qatar was sending most of its LNG to Asia. But the first reaction we saw in prices, it wasn't just natural gas prices rallying, but in particular, Asia LNG prices rallying more than European gas prices, because that's the first reaction. Listen, if I don't have my LNG, I'm going to have to bid up LNG from somewhere else. So you start to price higher to attract more Atlantic basin supply to go to Asia instead. And this pushes that deficit towards Europe. Europe is the one that we think will end up losing. And again, to be fair, the more price sensitive countries will let go from a little bit of it as well, like India, Pakistan, Bangladesh. But overall, we tend to see Asia willing to pay to get the LNG one way or another. So yes, we do expect that Europe is going to feel it. You look at the stats right now, if you look at how much LNG is going to Northwest Europe, hasn't changed much at all. So we're not there yet. If you look at storage, it's not drawing much at all. Also because it's been mild in Europe, so they've gotten a little bit lucky that way. If you look for the past, I'd say 10 days or so, storage, which would have normally be drawing this time of the year, it's almost flat for Northwest Europe because it's been so mild. So far, so good. But already, if you look at data on loadings, who is loading LNG to go where from the suppliers? And you already see US, Nigeria, loadings to Asia picking up, loadings to Europe dropping. So there are changes in the works that will show up in the import data, I think, in the coming weeks.
And it'll be interesting to watch that because, of course, back when Russia invaded Ukraine, it was Europe since pulling cargoes to offset its own loss and the pain being felt in a lot of Asia. Sounds like so far, Asia's been bidding it up away from Europe. So we'll, I guess, keep hoping for mild weather in Europe. I also wanted to ask, there was an announcement, of course, I think this week, of a coordinated release of global strategic oil reserves. How much can that help offset this disruption if this continues?
Yeah, so the announced release, 400 million barrels, it sounds like a lot. It is a lot if you think, okay, how many days of the conflict can this cover? And it can cover over 20 days of the disruption of what we're losing. But I think the key issue is the pace at which you release this oil. You can say 400 million barrels, but on a daily basis, we're probably talking max 3 million barrels a day. So if you look at how much you're losing every day and taking into account the reroutes, everything the market has been able to do so far to moderate the loss of oil, we're losing 16. So if you're losing 16 and now you can moderate it by another 3 or so per day, you're still losing more than 10 million barrels a day, which means it's going to be very difficult to avoid OECD commercial stocks from drawing down significantly in the next few days or weeks for as long as this disruption lasts.
Coming back to the point on refined product disruptions, how are we in terms of refinery placement to be able to actually use this crude oil? Or do we have refineries in the Middle East that'll be offline, that the release of strategic oil reserves might not help as much on the refined product side if this continues on?
You're right, in the Middle East, that's going to be hard because you have refining capacity offline, but it's going to help in Europe, it's going to help in Asia, even in the US as well. So it helps to put a band aid on it elsewhere, but it's not as if you could use the whole infrastructure in the system because, as you point out, some of it is disrupted at the moment.
And of course, we don't have strategic natural gas reserves. And with the US exporting about as much LNG as it can, if this goes on, how much resilience is in the system to deal with an ongoing loss of the Qatari LNG?
There isn't much. With gas, you go straight to demand destruction because you don't have where to take it from. Storage is not meant to be drawn down over an extended period of time, especially now. We're at the end of winter, right? So the natural gas winter is defined as the period when demand is typically higher than supply because it's cold. So you draw inventories down to complement your source of supply. Okay, we're at the very end of that, at the end of March. That's usually when that ends, which is good news because if we need to draw it down now, it's not like we're going to have a big heating related demand push in the next month. It's the opposite. Demand will be going down. But this is the time for storage to start rebuilding ahead of the next winter. So we don't have the luxury to keep drawing that down, which means that prices will resort to demand destruction. The most common way that happens is usually gas moves to be more expensive than coal. And then you start using more coal, less natural gas. This is already happening in Europe. One of the issues, though, is that in Asia, gas is always more expensive than coal. So as gas rallies, you're not really changing your relative price all that much. So you don't get the switching in Asia that you're getting in Europe right now, which means that we need something else. That something else could be gas to oil switching. So that means gas is going to look at the price of distillate fuel, which at the moment is at least about 50% more expensive than where European natural gas is pricing right now. So that could be a big rally to try to offset some of these losses. I would say the way that the market is pricing at the moment is not at the distillate level, even though I think that would be the most cautious way to price it to guarantee some additional demand destruction. But the way the market is pricing is to maximize that switching versus coal. And to be fair, if this conflict lasts, let's say a few weeks, we're 2 weeks into it now. So let's say it's more moderate in duration, pricing above coal throughout summer can do the job. This is not so unreasonable if we think of what we need to do in the market to offset these losses. And this is what's being priced right now.
So it sounds like on the gas side, the flexibility is in the seasonality. This is a good time of year for this to occur. And the market will be thinking about, do we have time to rebuild inventories for the start of next winter? And the longer this goes on, the more that could become a concern. So far, so good.
Yeah, but you have that deadline looming in the horizon. Yeah.
While we have this current disruption, maybe taking a step back, the demand for power, even though we have more installed renewable capacity and that's been helping, the demand for power and natural gas continues to increase, driven by decarbonization efforts, security efforts, as well as AI data center demand. How big a driver of change in our energy system are both of these? And are they making our energy system more or less vulnerable to these types of disruptions?
I haven't heard much of decarbonization prioritization recently, to be honest. The focus has been a lot more on security of supply, which we discussed a little bit earlier. And yes, data centers. And this is seen as a bit of a race. One of the main factors that we think will influence this race is the capacity to generate power. Because one thing we notice in the US is, to be very clear, it is the leader in the race right now. You have, as of the end of last year, you have over 40% of all data centers in the world in the US. But you have a few regional power markets in the US already starting to show signs of tightness as a result. You install these data centers, this contributes to power demand growing very quickly. If your infrastructure is not growing as quickly, you're going to tighten up. So we're seeing spikes in real time power prices. We're seeing spikes in auction prices. So the price that you agree to pay somebody to build additional capacity down the line, and this is a sign that we're growing demand a lot faster than infrastructure. And the issue is, if you look at how power demand growth in the US behaved over the previous several years, it was barely growing. It was barely above zero per year. So nobody had been investing that much in growing power generation capacity. Even when you look at the manufacturers of gas turbines, they didn't invest in increasing that capacity to build turbines because there wasn't enough demand to justify it. And now all of a sudden, that's all everybody talks about. And you say, okay, I'm going to build a data center. There's no infrastructure. No problem. I'll do behind the meter. I'll have my own generator. Well, yeah, but you still need a gas turbine to run it. And guess what? It's a 4 to 5 year queue to get one. So you end up with this possibility of the leader of the race having to slow down its pace a little bit over the next few years if you can't resolve these infrastructure bottlenecks. Now, contrast that with China. In China, power demand had already been growing at multiples of the US. In fact, more than 20 times the pace of the growth in power demand in the US. So they have been investing in capacity. They are growing coal generation capacity, gas generation capacity, which they don't use very much. They have huge spare capacity. They are growing renewable generation. They are growing battery capacity, nuclear power. So it's a completely different setup. I mentioned earlier that the US has over 40% of global data centers. China was number two, or has been number two, at about 25%. But if you look at all this spare capacity, you can already see the potential for that positioning, that ranking to swing around. So this is something we're paying attention going forward. But like I said, the focus has not been so much in natural gas when it comes to China, because this is something they are net short of. So yes, they're growing their power demand, and yes, they're growing generation capacity across pretty much every fuel. But what they choose to actually burn, not focused on gas. It's more coal, it's renewables, it's nuclear. They just have the spare capacity there just in case.
And thanks so much for making time for us this morning, Sam. Before you go, I wanted to ask, because in your role, you talk to people across all parts of the industry and the marketplace. So I was curious if you could share with us, what is the state of the conversation right now in the markets, and how are people thinking about weathering this disruption?
You see different sources of focus depending on where they are in the chain, right? So, for example, if you think of oil and gas, well, especially oil producers, I should say, in the US, there has been an opportunity for them to hedge their exposure with the rally in prices. So we have seen an interest in that. In contrast, if you think of LNG sellers, you have a lot of LNG sellers in the world that buy LNG from the US and they sell it either in Europe or Asia. And with the rally in European and Asia prices, this has widened the arb that they face. So they are looking at that as an opportunity to hedge this differential between the price at which they buy and the price at which they can sell. Now, when you talk to industrials in Europe, that's when it gets a little bit trickier. We also already hear of a lot of interest in hedging. None of them have executed, but you see that they are already going into risk management mode. They have been through something like this before back in 22. So I think they now know how to go through this. It's interesting. I remember after the 22 crisis, we always try to talk to industrials as often as possible to understand exactly how they navigate a crisis like this. And I remember talking to an industrial user of gas. This was a few years ago after the European crisis, asking them, so when gas prices spiked above every other fuel, did you switch away from gas and into oil? And they said, we wanted to, we tried to, we worked our machinery to change it, adapt it to burn oil instead of gas, but it took so many months that by the time we were ready to do it, it wasn't in the money to do it anymore. So I imagine right now they are ready to do it. They've already done the work to adapt their equipment, but not everybody will be responding the same way. Some companies back in 22 were ready to switch, say, from natural gas to propane. So if you have this spike in natural gas continuing, I'm sure that they'd be ready to do the same again. But they are a little bit more vulnerable. Like I said, the exposure to imported energy is higher than in other places. So we expect to see a little bit of this concern with risk management. They'll be able to do some hedging, but it's hard to protect themselves completely against this.
Thanks again to Samantha Dart, co-head of Global Commodities Research at Goldman Sachs. We hope you enjoyed the episode. We'll be back next week with a special episode of Smarter Markets Presents, Scenes from Boca 2026, the FIA Global Cleared Markets Conference. We hope you'll join us.
This episode is brought to you in part by Abax Exchange, bringing better price discovery and risk management tools to navigate today's commodities markets through centrally cleared, physically deliverable futures contracts in energy, environmental, battery materials, and precious metals markets. Smarter Markets are here. Contact sales at abax.exchange to get started. That concludes this week's episode of Smarter Markets by Abax. For episode transcripts and additional episode information, including research, editorial, and video content, please visit smartermarkets.media. Please help more people discover the podcast by leaving a review on Apple Podcast, Spotify, YouTube, or your favorite podcast platform. Smarter Markets is presented for informational and entertainment purposes only. The information presented on Smarter Markets should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Smarter Markets are those of the participants and do not necessarily reflect those of the show's hosts or producer. Smarter Markets, its hosts, guests, employees, and producer, Abax Technologies, shall not be held liable for losses resulting from investment decisions based on informational viewpoints presented on Smarter Markets. Thank you for listening, and please join us again next week.